We all want the money we save for retirement to last as long as we do and provide us with as much income as possible or without any risk or running out of money. However, the money we saved in a 401k, 403b, IRA, or SEP IRA plan is simply not the best way to grow and protect our retirement savings or provide retirement income for the rest of our lives without the risk of running out of money. Why? Because there are three critically important problems with these plans that are seldom brought to our attention, even though they actually reduced our retirement income by as much as 40%, and they are all avoidable. The three problems are income taxes, investment losses, and management fees. Let's begin with the taxes because the money that we deposited into a 401k, 403b, IRA, or SEP IRA, and the growth on that money are only tax deferred. So all that money is still taxable and the rates are likely to be higher than they are today. But even if they are not higher, we must still pay more taxes on our retirement income than we get to deduct on our retirement savings. For example, if we've saved $500 a month for 30 years, that's a total of $180,000. And if our money grows at a rate of 5% a year, we can withdraw $2,734 every month for the next 20 years. That's a total of $656,000. So we get a tax deduction on $180,000 over 30 years, but we pay taxes on $656,000 over 20 years. We are simply trading a small tax deduction for a large tax liability. Now, let's consider investment losses, because most of us have our retirement savings invested in the stock market or mutual funds. And while we can grow our money in the stock market, we can also lose our money in the stock market. In fact, during the last decade, the 10-year period from 2000 to 2010, the S&P 500 stock market index increased in 6 of those years and decreased in 4. But the net result for the 10-year period was a loss of 9%, or 9 cents on every dollar invested, which means that $100,000 in a retirement savings account tracking the S&P 500 from January 1st of 2000 to January 1st of 2010, we've actually lost $9,000, leaving only $91,000 in the account after 10 years of stock market investment. And if we have already retired during this 10-year period, we wouldn't have had any earnings from which to withdraw income, and we would have needed to spend out our savings until we ran out of money. However, if we've been able to avoid those 4 years of investment losses, we would have earned a compounded annual growth rate of almost 8%, and our money would have more than doubled over the same 10-year period by simply avoiding any investment losses. We could have gone from losing $9,000 to gaining more than $100,000. And it's not just the money we lose, but the time we lose as well. For example, when the market loses 40% of its value as it did between 2001 to 2003, and again in 2008, we need to earn at least 10% in each of the next 5 years just to recover our losses and get even again. What's more, our retirement savings accounts also charges management fees that can range as low as 1% to as much as 2% or even 3%. But these are not simple one-time charges on each deposit into our accounts. These fees are a percentage of our entire account value, deducted every year even when our accounts lose money. And now, fees of 2% or 3% might not seem as much. These reoccurring annual deductions are actually very costly because every 1% we pay on our account balance over 20 or 30 years will leave us with 20 or 30% less money on retirement. So how can we protect our retirement savings from income taxes, investment losses, and management fees? Talk with the financial security professional who asked you to watch this video.